Welcome to Wealth Chapters, the channel where we break down the most powerful books on wealth, investing, and personal growth, one chapter at a time. All right, let's just jump right in with a question. It's something we've all thought about, right? You see a company that's just everywhere. Everyone's buzzing about it. The stock is just shooting for the moon. So it's got to be a fantastic investment, doesn't it? It just feels right. But what if that feeling, that common sense, is actually leading you down the wrong path? Well, today we're digging into a powerful lesson from Chapter 18 of Benjamin Graham's masterpiece, The Intelligent Investor. And let me tell you, it completely flips that popular idea on its head. So, Graham warns us about this thing. Let's call it the popularity trap. It's this super appealing idea, right? That the companies with all the buzz, all the hype, are just automatically the smartest place to park your cash. But, as we're about to find out, popularity can be a really, really deceptive guide. And you know what fuels this trap? It's something called market sentiment. Really, you can just think of it as the vibe of the market. It's the collective feeling, the mood of all the investors out there. And it's driven by pure emotion, excitement, hope, sometimes even panic, not by the actual, cold, hard numbers. Chapter 18 basically says that if you invest based on that feeling, you're setting yourself up for a bad time. Now, to really hammer this point home, the chapter does something brilliant. It sets up these direct comparisons, head-to-head, between different companies. So for us, let's boil it down to a simple story, a kind of parable we can all get behind. Let's call it A Tale of Two Companies. Okay, so in one corner, you've got the market darling. You know this company. It's the one plastered on magazine covers, the talk of the town. Its stock price is sky high because everyone expects it to change the world. It runs on pure hype. Then, in the other corner, we have the quiet achiever. This company is just solid. It's profitable, it's run well, but honestly, it's kind of boring. Nobody's throwing a party for it. It gets overlooked, and because of that, its stock is selling at a much more down-to-earth price. So there is your choice, the shiny superstar or the steady, reliable workhorse. What Chapter 18 did was track pairs just like these for years and years, and a really fascinating, almost predictable pattern started to show up. The performance of these two company types, well, they didn't just drift apart. They diverged, and sometimes they diverged in a huge way. So, what do you think? Who came out on top over the long haul? Was it the celebrity stock, the market darling that everyone was cheering for, or was it the one nobody was paying attention to, the quiet achiever? The answer? Well, it might not be what you expect. Time and time again, over the long run, it was the quiet achiever that actually delivered the better returns. So why is that? Think about it. The market darling was already prized for absolute perfection. Any tiny mistake, any hiccup, and that stock price could just crater. But the quiet achiever? You bought it at a fair price, so it had all this room to grow and exceed those much lower, more realistic expectations. And here's the kicker. This wasn't a fluke. It wasn't just a one-time thing or a lucky guess. Graham laid it all out. He looked at multiple pairs of companies, and this exact same pattern showed up over and over and over again. The less flashy, better valued company comes out ahead. It's like a fundamental law of the market. Okay, so that brings us to the real heart of Graham's whole philosophy. If chasing the hype is a recipe for losing, then what's the winning strategy? Well, it all boils down to one simple but incredibly hard word: discipline. It's about having the mental toughness to just tune out all that noise and focus on what actually matters. See, Graham's big lesson is that we need to build our decisions on a totally different foundation. We need to be looking at the real business fundamentals. Things like how much money the company actually makes over the long term, how much debt it has, not the market's mood swings. It's about doing the homework, really analyzing the company's price, and, this is the most important part, having the guts to stick with your analysis, even when it feels like the entire world is running the other way. And that right there, that's the whole message of this chapter in a nutshell. It's not about having a higher IQ than the next person. It's about being more disciplined. The market's feelings will change like the weather, but a solid business, that's built to last. And that's where the intelligent investor keeps their eyes. All right, so how do we actually use this? This is powerful stuff, but the book was written a long time ago. How do we make it work for us right now? It all comes down to creating a simple process you can follow every single time. So here it is, a super simple checklist, straight from the wisdom of Chapter 18. Step 1. The next time you hear about some crazy popular stock, your first reaction shouldn't be, how do I buy it? It should be, what's the catch? Question it. Step 2. Do your homework. Dig into the numbers behind the story. And step 3, always, Always put value first. Ask yourself that one simple question: am I actually getting a good deal for this business? And that really leaves us with the one last critical question you have to ask yourself before you ever click that buy button. It's the ultimate test of the discipline we've been talking about. Are you buying a great business, or are you just buying a popular story? Getting that answer right, well, that can make all the difference in the world.